Welcome to Bull vs. Bear, the channel where markets clash and opinions reign. I'm Kleven, your resident optimist, always charging ahead with the belief that the market is heading up.
And I'm Chip, the realist, your bear, here to remind you that not everything that goes up stays up. Together, we're diving into the world of finance, stocks, and options, giving you our take on the market's movements. But remember, this isn't a financial advice channel, it's just our opinions.
That's right. Think of us as two voices on opposite ends of the spectrum, hashing it out on what's happening and what might come next. Chip, why don't we kick things off by telling the listeners what to expect from Bull vs. Bear?
Sure thing. Each episode will go over Cleven's active portfolio, cover key market news, trends, and some hot takes. Cleven, you know I'm an amateur passive investor. My money is in index funds and ETFs. You actively manage your portfolio, including investing in options. Walk me through your portfolio this week.
All right, Chip, let's go ahead and go through the portfolio. So for this past week, we had a 7% return. I call that a banger. Banger week. That's a banger. 7%.
Yeah,
That's goaded.
pretty good. Yep.
Goaded.
Uh-huh.
So I want to actually for this episode, I really want to focus on one stock in particular, SoFi. So
Okay.
SoFi is a stock I'm really excited about for next year. This is the stock I have the most active options on. I have three options actively open on it. So these are buy call options. So essentially, what a buy call option is, I'm paying someone who already has the shares of this company a premium. I'm paying them a premium on to buy their shares at a certain price. So, for example, Chip, if you had SoFi stock at you bought the stocks at $13, and
Mhm.
I had said, Chip, I'll give you $1,000 if the stocks hit $16 by the end of the year. I get to buy them from you at $16 a share. Now, if no matter what happens, you get to keep that $1,000 premium. If the stocks hit $18 a share, you get all of the profits from the 13 to the 16 on the stocks, and from 16 to 18, I get that profit.
Mm.
So
So in other words, we enter into a contract
yes,
where I'm going to sell you X number of the shares that I own at X dollar amount, and you pay me for the privilege of agreeing to that, and you hope that the difference between the amount you paid, called the premium,
yep,
and the total stock price will make you a profit.
exactly. Now let's before we go into my SoFi stock, let's talk about the pros and cons of this from my perspective. So I'm the buyer. I'm paying the premium. So if the stock isn't above $16, I lose my entire premium. The entire $1,000 just gone, wasted money.
Mhm.
The pro is I am using very little cash to lock up a lot of stocks. So in options trading, every options contract is 100 shares. So if I have 10, I can get 10 options contract, which would equal 1,000 shares for maybe $2,000, where buying that same amount of shares would cost me 15 to 30,000. So I lock up very little equity for a lot of stock potential.
Okay, and this is something I didn't understand until the other day when you were walking me through this. I was under the impression previously that every option, like if I was to enter into an option agreement with you, I had to exercise that option at the end, and then I'd have to resell the stock. But you recently told me that that's not true. You can just sell your current option position to another trader.
Yes. Actually, is it not almost true? You almost never exercise. I've opened and closed tons of options at this point in the last month. I've never exercised any of them. I've never taken the stocks. Now, I do want to go through SoFi because this is going to be the first stock I actually exercise an option on because I actually am very bullish on SoFi. I see SoFi next year potentially hitting $40 at the end of the year. Maybe that's too optimistic, but I think Trump becoming president is really going to rally the market. I think bank deregulations is going to excite investors in this space. So let's look at the options we have. We currently have three. We have one that expires at the end of December. It's for a $15 call option. And if you look, the break even price on this is 15.73. So for me to make money on this, I have to be above $15.73 per share. Currently, we're at 16.36. So we're in the money. This is an in the money option right now. We are in the money. This is what we like. We bought this November 18th. So in less than 2 weeks, we're already in the profit. We're up 150% on this option. Now I could sell this option right now, and we could just take the profits. But I'm gonna wait until the end of the year, and we're gonna exercise this option. We're gonna take control of the 5,000 shares. This is a 50 contracts. That's, remember, each contract is 100 shares. So 50 contracts, 5,000 shares. We're
Right.
we're gonna take control of these because like I said, I'm really bullish on SoFi. I think this has a lot of potential next year. I want this stock. I want to hold a lot of this stock and see it grow.
Mm.
But we're going to insure it in some way. When we do get the stocks, we're gonna buy some put options against them. So if the stock goes below, or we're gonna sell some put options against them. If the stock goes below a certain price, we can sell it at an agreed amount of price. So if this stock drops half, we don't lose a ton of money. It's an insurance in sense.
Can can you walk me through what a put option is? That's when you agree to if somebody purchases uh, the right to buy your stock at a certain price at a certain date, right? And
Yes.
they give you a premium for it. And the idea there is that,
Reverse. I paid them the premium.
oh,
So
you pay them the
I'm
premium.
paying. So hypothetically, I'm saying to them, if SoFi hits $10 and our agreed upon price is $12, even though SoFi stock's only worth $10, I'm selling it to you for 12, but I paid you $5,000 in advance for this option. Now, if SoFi stock doesn't go below $12, you get to keep that entire $5,000. And
Mm.
they have to put the collateral up in that amount of money. So if the amount of stock they would buy would be $50,000 worth, they actually have to have that as tied up collateral in their account. So that money is sitting there not being used, but they are getting that premium, and that premium is theirs no matter what.
Okay,
So that it's kind of like an insurance system for stocks. That's kind of how I think of it.
sure.
You're ensuring that you can't lose beyond this dollar amount.
And this is what people call shorting a stock. This action you just described is what shorting a stock is.
Yes. Yeah.
Okay.
So this contract we are going to exercise at the end of the month, which is kind of risky because right now we're up 150%. 150% return in 2 weeks. I don't know. How do you describe that, Chip? What's your words?
Uh, I'm not going to call it a 1.5 bagger or whatever you option traders call it. I'll call it risky is what I'd call it, but it is a good return.
It's an incredible return. If you're pulling 150% returns in 2 weeks, you're with Warren Buffett. You just that those returns, these are Goldilocks returns. 150% is insane for 2 weeks.
Yeah,
Um,
yep.
so this one we're going to exercise at the end of the month. I do have a slight problem. I am not liquid enough to buy this right now, so I couldn't exercise this currently. Currently we have about $450,000 out in the account, tied up between options, and then we have a lot of stocks. So we're gonna have to. So we have about 90,000 in options, and the rest of it's in stocks.
Okay.
So we're gonna have to offload one of these stocks because we're gonna need about, I think, 30 grand for this SoFi option.
What are
So
you investing in just traditional stocks right now?
so traditional stocks, I got Walmart. Walmart's been a good one. We like Walmart.
Mhm.
Nvidia, I got into Nvidia kind of late. Regret that. As a big computer gamer, I should have been ahead of this one. Nvidia is just a technology space. It's a winner. So I should have been in this one earlier. But we're down a little bit in Nvidia, like maybe $3,000. Disney's a big winner. We're up about $12,000 in Disney right now. Nike. Nike is actually one I really want to hold on to because I think Nike has a lot of potential. It's kind of at like a 5-year low, stock price wise. And I think they got a lot of potential. I think there's gonna be a lot of free cash in the economy next year. When there's free cash, people buy, luxury or like, nice to have items. Nike shoes, Air Jordans, these are nice to have things. If the economy's tight, people don't buy them. If the economy is free cash flow, people are buying these things. And then we have Robinhood. Robinhood stock, this one might get let go of. I'm not sure.
Mm,
Well, we've made a little bit of money.
ironic.
Yeah, I know. We've made a little bit of money. We're up 5% in Robinhood. We've also sold cover calls on this. But we've also made extra money on Robinhood, and we'll probably still do that until the end of the month just to make a little extra free cash. But we'll go back to SoFi. So we've got the December position that we're gonna exercise.
Uh-huh.
We then have a March 21st, 2025 position at $17 a share. And we have 25 contracts, so that's 2,500 shares that we have the potential to get. And our break even price on this is 18.89. I actually think SoFi is going to be at $20 for the end of the year. That's kind of bullish, but I think that's where we'll be at. Um, and like I said, I think next year we could look at $40, $45 a share price by the end of next year. So this one I will probably not exercise. This one I'll just take the profits on. So far we're up 20%. That's pretty good. We got a lot of
Yeah.
time left on this one. I mean, this expires in March, so we got like 4 months.
Okay. And uh, just to touch on something you mentioned
Mm-hmm.
earlier, the reason that these are going up at such massive percentage returns
Yep.
are because you purchase the right to snag these stocks from another trader. And as the stock increases in value organically, the stock price actually rises. The potential upside of your option goes up.
Yes.
But the closer you get to the actual, what's the date called where you must purchase or
Expiration
allow this
date.
to expire? Okay, so as you get closer to the expiration date, there's less unknown about the total price of the stock. So the farther out you are and the faster it's going up, the more valuable an option could be, right?
Yeah, I'd say there's actually even kind of like a Goldilocks spot. Like I feel like 45 days out is like that's really the kind of the peaking point in some sense.
Mm,
Too far out, you're almost a little worried like, well, if you're a year out, it could do anything. But if you're 45 days to 3 months out, you start really narrowing the window down. And you're like, wow, it's doesn't the chance of it going down X amount becomes a lot less per se.
right.
Now, there are some things that can change that. If you have an earnings call, when I started really really started my stock adventure about a month and a half ago, I took all my money and I YOLO'd it into Chipotle. And Chip said to me, Kleven, don't do this. I put $180,000 into Chipotle. We went from 180,000 to $200,000. I was giddy. And then Chipotle had their earnings, and I lost $40,000, and I wasn't so giddy.
Mm-mm. You were at your son's birthday party, and you called me up and you said, "Hey, Chip, I just lost $40,000," and I felt bad for you, even though I told you not to do it.
And I felt bad for me too. I felt really, really bad.
Hmm.
Now that being said, Chipotle came back. We made 5 grand profit, and we exited that company and never to look at it again. Um, now we'll look at
Except for lunch.
yeah, we'll look at Chipotle again. Actually, Chipotle has some good potential in the future. We did do a call option on it after that, and we made like another 5 grand. So we got out Chipotle, and we diversified into a bunch of stocks and a bunch of options. We're not YOLOing anymore. Too much money to YOLO with.
Hmm.
So for the returns, when you're talking about time and stock price, right? So there's two things that make an option valuable: time and stock price. If you actually click, this is in Robinhood. This is the app I like the most. You can use any one you want, E-Trade, Fidel, whatever trading platform you like. I think Robinhood is kind of stupid simple. I like stupid simple. I'm stupid and simple, so keep it easy for me. So there's a button here that says simulate my returns. So you can actually look at an option and see, you can change the price of the option. So if we put SoFi at, I think at the end of the year it's gonna be $20. So we're gonna move it up to $20. $20, close enough. 1998. So today, if SoFi was at $20, we would get our option would be worth $6,725 profit. Now, the closer we start going to expiration date, this option becomes worth, and this is if the stock price is exactly the same. If it doesn't move at all between now and expiration date, the option becomes worth less and less each day. Where
Right.
finally, at the very end, it becomes worth its actual value. This is the actual value it's worth. So you got to balance out the time factor versus the stock price factor and try to find the sweet spot. You know, the number one rule in real estate, location, 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 right, Chip?
Hmm.
I would say the number one rule in the stock market is timing, timing, timing. Everything's about timing, right? You pick
Right.
the wrong time, you're gonna lose, even if it's a good company. You know, you pick Amazon and they have bad quarterly earnings the next day. That stock's going down. So timing is really important. Um, that's something we want to look at is timing. So for this option, it expires in March. We're going to look at offloading this sometime in February. I don't think we will exercise this one. I think 5,000 shares is enough to hold. Now that being said, if SoFi hits $25 a share by March, we might exercise this and have 7,500 shares because if we have 7,500 shares at an average cost price of $17 and it makes it to 40, it's a lot of upside. And
Right.
we can kind of protect that with some put options along the way.
I think I'd be interested to get into your risk strategy in a future episode because it seems like that is probably key to trying to avoid making this any closer to gambling than it already is.
This is definitely very close to gambling. Options trading can be extremely addicting because in traditional stocks you're not getting 1,000% returns in 2 weeks. It doesn't happen. But in options trading, you can absolutely get 1,000% returns in 2 weeks. We'd even call that a 10 bagger if you get it.
Mhm.
They happen.
Yep.
And then we'll go to our last SoFi option. And this one's a far one. I actually might actually cancel this option out. I think I have too much equity tied up in it, and it's too far out. So this is a $12 call option. So,
Okay.
so this is so when you buy an option that's below the share price, it's called an in the money option. So if you buy it below the share price, it's in the money option. If you buy it at the share price, it's an at the money share price. And if you buy it above the share price, it's a out of the money option.
Okay.
So I bought this for a $12 share per SoFi share. Now, because of the premium I had to pay, my break even is going to be 1840. It's still pretty good. This is a deep in the money option. $12 is really good. And it goes until 2026. But because I bought it so far in the money and so far out, this is a leap option. It's over a year. It's a really long option. I actually paid $9,000 for this option. This is a lot of money to
Mm.
tie up. I actually think I made a mistake with this one. And it's important when you make a mistake, evaluate it. Don't hold on to your mistakes. Sometimes, you know, sometimes you can have a loser. I recently put $15,000 into Dell. Dell had their quarterly earnings and the stock price dropped. I lost $3,000. I could have held Dell for maybe a year, maybe 2 years with the $13,000 of equity I still had in the company and waiting for it to come back. It would have come back eventually. But I think I was actually better taking that capital out of Dell and putting it in something else that will make me more money. So sometimes it's okay to cut your losers.
Mm.
And that's not always a hard and fast rule. Sometimes you want to hold on. Nvidia is currently down for me. We're holding Nvidia. It's okay. That's going to be a winner long term. We're going to hold on to that. So SoFi's got 9,000 locked up in this contract, and it's only for 14 or in this option. It's only for 14 contracts, which is 1,400 shares. So this one we're probably going to sell off soon. It's already in the profit. We made 7%. This is good. Made $600 on it. We'll probably sell this sometime in the beginning of the year, and we'll take the profits, and then we'll put it in another SoFi option with more contracts in it and a shorter time frame.
Mm. Okay.
So that's our SoFi strategy for the upcoming year. Um, every week, the goal is to go through. We're gonna look at the portfolio every week. We're gonna look at what active options we have, and we're gonna take it from there. What do you got, Chip? What else? What else? Did we miss anything?
No, I think that's just about it. Next week we've got uh, a bit of a discussion on whether or not investing in a traditional home is a good or bad investment. Spoiler, it's not a good investment. I don't think either of us disagree on that. There are social elements that go into it, but we're going to talk through that, maybe debate a little bit back and forth, and then we'll decide new topics as we go.
I'm really excited for the housing conversation because you and I we both leaned one way on this, and I think we have both changed our position dramatically as we've talked about it. I'm really
Yeah,
excited for it.
me too. I think I was initially a big proponent in buying a house and paying it off as quickly as possible, but interest rates and just math proves that realistically that's not the average best decision for the average American.
And math doesn't lie, so we follow math here.
Hmm
All
hmm
right. Well, and that's it for this episode of Bull versus Bear. We'll catch you guys in the next episode.